Stockland's the largest diversified real estate company in the country. So we've got about just under 13 billion of assets, and I think in terms of what's going on in the business, probably gives us a reasonable insight to some of the micro views of things that Bill was talking to and Julian's touched on. Around half of our assets are shopping centres, and we have about more than 20 million visits a year to the shopping centres, so we get a pretty good view of what people are thinking and doing. There's a lot of technology in the centres, and that's certainly where some of the themes that Julian spoke to in terms of disruption from technology and e-commerce, etc., has certainly been very visible, and there's a lot of change that's gone on, and it's moved very exponential, and it's moved around fast casual dining and services, and really shifted away from the full-end discretionary of, say, a mall of 20 years ago. In that context, average growth is running around 3% or thereabouts, and that's nominal growth, so just only a little bit of real growth, but that's okay. Once again, to Julian's point, it's a bit variable. If you look at the mining exposed centres, and the Hunter's the best example. Coal's been hit pretty hard, and that's softer. You look at places like the Sunshine Coast, exposed to tourism, tertiary education, service growth as far as the university expansion is going great guns. So you definitely have this mix across the country. Industrial, logistics and business parks represents sort of 13-14% of our assets, very linked to retail. A lot of the logistics is all about bringing goods into the country, getting them out to shopping centres and getting them into the household. So once again, doing okay, nothing special, but okay, running around once again about 0.5% real. Office is sub 10%. Office has been pretty disrupted actually across the country. The things that shifted it post GFC, financial sector obviously came back a long way, starting to shift. You saw offshoring, insurance banks in particular, taking services offshore, places like India and the Philippines for call centres. Australia is probably about 10 years behind the rest of the world in that trend, so there's nothing sort of ominous to that, but that's had an effect. State governments in particular have downsized, and then there's activity-based working, which I'm sure, I know many of the law firms have moved towards, and that activity-based working just means a bit less space per person. So all those things have really hit the net take-up, and of course, Perth and Brisbane particularly hard hit with the mining services, subleasing a lot of space. Sydney and Melbourne actually now starting to do a little bit better, starting to see the service sectors expand and some employment growth there, and also a lot of removal of older stock for conversion to apartments. So it's been pretty strong. And then a third of the assets sit in what I'd call residential, and the residential is a combination of traditional housing, which is the bulk of it, and profits there are up 58%. Not actually around price growth, but more around volume growth, starting to shift back to normalised levels, and also some improvement in our underlying portfolio. And then retirement living, which is an interesting sector, very strong demographic drivers with an undersupply across the country, but only 5% of people over 55 living in a retirement village, which is quite interesting. We survey all our customer sets, and our customer satisfaction with our services, whether it be in the shopping centres or the logistics and business parks or retirement villages or resi, it's all over 80%, and retirement's actually over 85%. And we look at the happiness or the satisfaction ratings of our residents, well above average, but I do think the industry has a bit of a brand challenge, and there has been a whole lot of different perceptions there, but that's a sector we think is very interesting longer term, obviously given the powerful underlying driver of an ageing demographic. And then just briefly, and then I know I'll be out of time, I just wanted to put up a couple of slides which are a slightly different version of what Bill put up, but it does highlight and put into context some of the commentary that's going on. So this is a slightly longer chart, as it relates to price growth, and I think you can see, while we certainly have had some improvement, particularly in Sydney and Melbourne, It's certainly not across the whole country. In the context of prior periods of improvement in markets, it's nothing particularly untoward. The big driver of housing, as it is of course of our business and of the economy, is migration and natural increase in population. So, and it's about 50-50 for what it's worth. It's not all about migration in terms of our population growth and our household formation rates. But our household formation rates are 1.8%. That is the highest in the developed world. So taking a medium to longer term view of Australia, Australia has the highest potential growth in the developed world, which is something that gives us a fair bit of optimism about the future. This chart just tries to look at metropolitan areas, and it just looks at the relationship between new construction or supply and of course demand through that household formation. And what you see is that particularly post-GFC, a lot of the builders and developers really pulled in their horns, a lot less construction, of course migration and natural increase continued, and as you can see, we have an undersupply in every market in the country. This is most acute in Sydney, where obviously Bob Carr famously said Sydney is full. Everyone scratches their heads about that, but at the end of the day, we've got about 5 years of undersupply to make up for in Sydney. Now we've got massive infrastructure spend planned, 20 odd billion. It's going to completely redefine the urban form. Governments want to urbanise and reconvert brownfield locations. There's more than 250 sites in Sydney alone that will experience that. One of the most prophetic will probably be the Bays precinct, which will open up about 58 hectares of waterfront land, which will be unprecedented in the history of Sydney. But that's going to be a game changer, and that will help to address this undersupply, but it's going to take about 5 years to fix it up, which is why you'll keep seeing price growth, although we don't think it'll be anything like what you've seen. You don't bank on 15% a year. If it does, it'll blow up, a bit to Bill's point. But certainly around 1% real, 3.5%, 4.5%, 5%, quite sustainable. And then the last piece, which Bill also spoke to, is just looking at mortgages and serviceability of loans to income. And of course, what do you have? You've got a little bit of improvement around the GFC with rates coming back and prices coming back a little bit. But for the best part of a decade, this level of affordability or challenge is there and present, ever present. There is an affordability challenge for first home buyers in the whole world, except for the US. And that's because you've got so much arable land. But if you go to New York City, it's a lot dearer than it is here in Sydney. I'll tell you now, 40 miles out, Shanghai, and this is obviously mispriced asset class that will retrace, but you'll pay for a 5-storey townhome on 200 square metres next to high tension power lines and a paddy field with a little bit of a crappy golf course, about $6 million US. So in that context, think about the relative value of Australian real estate, and particularly given our lifestyle, the quality of the food, the quality of the education, quality of healthcare, quality of all those things that money can't buy actually, which given there'll be 1.2 billion more people in the middle class in Asia in the next 8 years, and you think about Maslow's hierarchy of needs, as they move into the middle class, guess what? They start to have more discretionary buying power, and they're quite interested in things like healthcare and education for their children and food quality and those other things. And quite frankly, buying an apartment in Sydney or Melbourne or wherever else, or a house, is actually a very cheap option. One last number I'll leave you with. Last time I looked, on the peak in Hong Kong, a nice home will set you back about $150 million US. So think about how many waterfronts you're going to buy for $150. Anyway, I'll leave it there and we'll go to Q&A.